Today, latest CPI data says services inflation is still riling. Hi again, it's Martin North from Digital Finance Analytics, world latest post covering finance and property news. On Wednesday, the BLS released the latest US inflation data. And top line, it appears the post-pandemic spike in inflation in the US eased further last month, as year-over-year price increases reached a 3-year low. However, while the spike in goods, food and energy prices is over, services inflation remains uncomfortably high. Consumer prices rose 2.5% in August from a year earlier, down from 2.9% in July. It was actually the fifth straight annual drop and the smallest since February 2021, and just below a 20-year average for the first time since 2020. Inflation peaked back in the middle of 2022 at 9.1%. That's the highest rate in 4 decades. And from July to August, prices rose just 0.2%. However, excluding volatile food and energy costs, the so-called core prices rose at 3.2% in August from a year ago. That's the same as July. And on a month-on-month basis, core prices rose 0.3%, a slight pickup from July's 0.2% increase. Core, of course, is closely watched by economists as it typically provides a better read for future inflation trends. And by the way, on Tuesday, the Census Bureau reported that the median US inflation-adjusted household income rose 4% last year to above $80,000 US, essentially matching the 2019 peak. So in real terms, people are ahead. America's paychecks are growing more slowly now, an average of about 3.5% annually, still a solid pace, which reduces inflationary pressures. But 2 years ago, wages growth was about 5%, a level that could force businesses to sharply raise prices to cover their higher labour costs. But, of course, it is important to look at the elements which flows into the headline CPI. For example, a key reason for last month's drop in overall inflation was the third drop in gas prices in the past 4 months. Average gas prices fell 0.6% from July to August and are down 10.6% from a year ago. A number of trends suggest that inflation will keep slowing. Those signs include a drop in oil prices to roughly $67 a barrel early on Wednesday, down from a high of $80 last month. A recovery in China or elsewhere matters here for future oil demand as much as the complexity of the conflicts in the Middle East. And meantime, by the way, the US keeps pumping oil supply at record rates. Another factor in the CPI is used car prices, which fell 1% last month. Measured from a year earlier, used car prices have tumbled 10.4%. But on the other hand, grocery prices were unchanged from July to August, extending a cooldown in food costs, even though they remain much higher than they were 3 years ago. Over the past year, grocery prices ticked up just 0.9%, similar to the pace of pre-pandemic food inflation. Importantly, the tick-up in core inflation from July to August reflected an acceleration in housing costs and some spikes in the price of airfares and hotel rooms, which are likely to prove temporary, perhaps. Airfares jumped 3.9% from July to August after having dropped the previous 5 months, and hotel room prices climbed 1.8% last month. They had fallen in 2 of the previous 3 months. Shelter, though, highlights another serious issue, the high level of sticky inflation for services and commodities whose prices take a longer time to change. Including shelter, this measure, calculated by the Atlanta Fed, remains above 4%. If shelter is ignored, it's below 3%, making it far easier for the Fed to start easing. And market data on new rents shows that the median rent for a new lease rose just 0.9% in August from a year earlier to around $1,645 a month. But it takes time for the slowdown in new rents to show up in the government's data. Last month, rental costs rose 5.2% from a year ago. That's according to the government's Consumer Price Index. The anti-core, that's the index of just food and energy, is now remarkably showing deflation. But the supercore measure of services excluding shelter, which is most directly exposed to wages and should therefore be drivable by monetary policy, unlike food and fuel, is proving stubborn. The Fed's policymakers have signaled that they're increasingly confident that inflation is falling back to their 2% target and now shifting their focus to supporting the jobs market, which is cooling just a little. As a result, they are poised to begin cutting their benchmark interest rate next week from its 23-year high in the hopes of bolstering growth and hiring. A modest quarter-point cut is now widely expected. The pickup in core inflation makes it unlikely that the Fed will consider cutting its key rate by a larger than usual half point next week, as indeed some Wall Street traders had been hoping. But the big question now is whether we are in a pre-recession period in the US. Markets continue to expect big cuts ahead, and bond yields are responding accordingly. But Ian Harnett of Absolute Strategy Research showed every time the 2-year Treasury yield, which is driven primarily by Fed expectations, has fallen this far below Fed funds over the past 60 years, a recession has followed soon after. Yet, if the economy is in as bad shape as the bond market implies, you would expect corporate profits already to be under pressure, with credit defaults on the rise. At the moment, that's not happening, at least so far. If that remains the case, then perhaps the big cuts expected by the markets just won't come. And there is the old thorny question of what the neutral rate or the R-star rate is. That's the rate which neither supports nor breaks the economy. I suspect it's higher than many think, which means the room for more cuts will be limited by those stubborn services costs. And elsewhere, the most hawkish member of the Bank of Japan 9-member board, Tamura, indicated that the central bank there needs to raise its benchmark rate more aggressively than many economists have been expecting, noting that the neutral policy rate in Japan is 1% or higher. The yen advanced against the dollar after his remarks, before paring gains later. And the ECB is expected to cut today, Thursday, lowering its key rate to 3.5% from 3.75%, but is expected to remain tight-lipped on the pace and extent of future action, given that inflation isn't yet fully defeated. Services inflation is still not behaving, and I don't expect the ECB to give a neutral rate target either. The Stoxx 600 index has stumbled this month after rebounding in August as concerns about global growth weighs on stocks, and that's also linked to the economic cycle and commodities such as oil. Most analysts forecast rate cuts in September and December in the ECB, maintaining that quarterly pace until reaching 2.5% a year from now. That endpoint is where many estimate the so-called neutral rate is. Finally, note that Chinese stocks fell to their lowest since January 2019, which is a grim reflection of how investors have lost faith over a recovery in the country's earnings and economy. The CSI 300 index closed down 0.4% on Thursday, taking its slide since a May high to around 14%. The benchmark of onshore shares is also headed for an unprecedented fourth straight year of losses. There, of course, target rates are being cut to try to support the weakening economy. For Australia, where inflation is higher and rates are unlikely to change this year from the current 4.35%, the economy will be buffeted by weaker demand from China, the rate cuts in other places, and other externalities, which might once again highlight the dilemma we're in thanks to poor monetary and fiscal policy in recent times. And again, the neutral rate does now appear to be higher, so we should not expect rates to miraculously slide towards zero. We are now in a higher rate forever environment. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.